This is Jay Martin.
Can we begin with a quick introduction of who you are? So 30 seconds or less. Ivan, love to start with you. Who are you, and how do you spend your time in this industry?
Great. Thanks, Jay. Great to be here. I'm a mining entrepreneur. I've been in this business for 23 years. Actually, early in my career, I met Rick as a fellow contrarian, or so I learned. It's good to be one. I took on the effort to go find mines around the world, and we found two of them, one which resulted in a huge success for shareholders, and both of them did. I've fought bull markets, bear markets, I've seen it all, and right now I'm the CEO of a public company that's not listed and the chair, director, or founder of three other ones. So like a lot of investors here, I have massive exposure to the juniors. The last 18 months raised about $60 million with my colleagues, and got to see all facets of market and learn from very smart people like Rick here to my right.
Love that, thank you. And Rick, for the room, please, one more time.
Rick Rule. I just failed retirement, mercifully. So I'm no longer involved in any regulated capacity, which means I don't report to the SEC or anybody like that. But I am in retirement, starting a new bank. So any of you who aren't comfortable with your current banking relationships, please look me up. We'd love to battle for your business. That's what I'm doing.
All right, thanks, Rick. Now, okay, I'll start with you, Ivan. Right before I hopped on stage, we were chatting, and we were comparing notes on sentiment over the years. And I've been running these conferences for about 12 years. The majority of that time, investors have been running away from the industry quickly. And I shared a story about a conference I ran in Saskatoon 6 years ago. Actually, I'm not going to lie, I put on an attendee badge, just walked around the floor so people would think that somebody had shown up that day. That's how bad it was. So things aren't that bad, right? But we could say the metals prices aren't performing as we hoped they would. And I want to start with that, Ivan. So, if we all believe the macro indicators, if they look so positive, and sentiment supporting this, why are the juniors in a rout right now?
I think is a natural lag you see at the top of markets. If you go back to 2011, when the stocks were still doing really well, gold was coming down, but the stocks were doing great. And I think on the way into a new market, you get the same lag. Fundamentals are overwhelmingly clear, but stocks aren't reacting. I do live half time in the US, and I get both sides of the border to see the mentality of investors. And right now, a lot of American investors, which is a big part of our market, they're worried about a stock market crash. They're worried about losing. They're seeing crypto get hurt and everything else. They're not worried about winning. And the second part about it that I've noted is cryptocurrencies or cannabis. These are reasons to go speculate and where you could make money. Mining is the next place. I think that's all clear to all of us, but people are still losing in those speculative markets. So speculative money seems frozen. It seems on the sidelines. People are afraid of a crash, not afraid of making money. And my last point is our industry has gotten a lot smaller. People are promoting it a lot less. Good things are happening in companies, but there's no reaction. So if there's no reaction in share prices, fundamentals keep going up, it creates a certain level of frustration. So I think that's where we are point of market right now.
And given that outlook, Ivan, what would you advise investors do right now?
I hate the word, and I love it at the same time because it always works well, is be very patient. This is the point of market where you hold on really tight. If you can take the emotion out of your investment and look at the fundamentals, and don't worry about where you bought, worry about where it might go from its current price. And that'll put you in a lot better mood to wait from where things are now. If the company's fundamentals are improving, you stay long, you wait, you hold on, and it's a dangerous time to lose positions, but my advice is to be patient.
And Rick, anything you want to add to that, or anything that you are doing right now that you can share?
Well, I'm embarrassed to say I want to disagree with some of it. The first thing is that the malaise in the junior, how many issuers, how many exhibitors are in the audience? Good. None of them armed? So I think that the junior market trades above where it deserves to trade. I think the junior mining market is where money goes to die. If you merge every junior mining company in the world into one company, Junior Explorco, in a very good year, that business would lose $2 billion. In a bad year, it would lose $6 billion. So how much money would you spend on this business? Would you buy it at 8 times losses? 12 times losses? 16 times losses in a bull market? Now, that gloomy overview hides the fact that 5% of the issuers in the market generate so much performance that they add credibility and sometimes luster to the lame, the halt, and the blind, which is the other 2,000 issuers. So the first thing that I would say is do real work to segregate the lame, the halt, and the blind. The reason that the junior sector is in a malaise is because the junior sector's performance over 40 years has been almost unblemished by success as an industry. Individual issues have done well. Now, the other question, of course, is when will investor perception around commodities increase? And I would suggest that that happened 4 years ago. In other words, it isn't going to happen. It's already happened. It's just that investor expectations are so incredibly goosed that rather than seeing the gold price having increased from $1,200 to $1,900, they see it having fallen from $1,980 to $19. Which is to say, when is it going to happen? It's already happened, and it's going to continue to happen. I remember back to when I cut my teeth in this business, which is, as you can tell, a long time ago. 1968, 1969, 1970, 1971, 1972. The writing was on the wall for inflation. The writing was on the wall for commodity shortages. But investors had lived through two benign decades, the late 40s, the 50s, the 60s. And inflation was to them a sort of an academic thing because it hadn't bitten them. But after 4 years of wage increases that didn't keep pace with inflation, after 4 years of seeing the purchasing power of their accounts fail year after year after year, after 4 years of the writing on the wall, people became interested. Now we've had negative real interest rates, obscene negative real interest rates for 18 months. But people have lived through 40 benign years. It hasn't bit them yet. It will bite them, and when they do, they will be interested. And they will lose billions in the junior resource industry. Whether you join them or not depends on how much work you do.
Thanks for that, Rick. Okay, so
this is from a guy who has to please the exhibitors, but I've retired now. I don't give a damn.
Well, okay. I appreciate your honesty, and I appreciate the malaise in the market, to be honest with you, because there's a handful of companies that I loved a year ago, still like them today. They're 40% cheaper, right? Ivan, you're one of these, right? You're one of the entrepreneurs that I just follow around in this business, if I'm being honest. The advice Rick gave me, I shared this morning a couple of years ago on my podcast, was he said, at the beginning of my career, if I had only followed the same 3 or 4 entrepreneurs and not done anything else, I would have worked 10% as hard and earned 10 times more money. And I'm not reinventing the wheel. I found my entrepreneurs and I'm following them around. So look, I see this as a buying opportunity because I liked these companies a year ago, so I should like them even more now at 40% discount. Would you attribute that, though, to the broad market? And as a consequence, would you forecast more M&A? Would you forecast M&A to pick up a little bit during this price depression?
I hope so. I mean, the company has way too many management teams, and it has way too much G&A. And in a successful M&A transaction, you lower management, general, and administrative expense relative to assets under administration or project expense. The problem is that every manager wants to survive. Nobody wants to be acquired. Everybody wants to, I mean, you know, when managers talk about real returns, what they mean is officers and directors' salaries and emoluments. Right. And the consequence of that is that the thing that slows up M&A is that everybody wants to acquire and nobody wants to be acquired. I hope it happens.
Ivan, you want to add on to that?
Yeah, just the hard part about M&A is when the market's down, your prices are down. If you go buy something, you're going to dilute. That's the perception. But if you look back to past cycles, the people who do merge at these times, they come out as the biggest winners. Yep. The hardest thing to do is to convince a CEO to go buy something when his stock is cheap, but he's buying something cheap, and that's always missed, right? And this goes right up to the majors. People buy when things are expensive, and they sell when things are cheap, or they don't buy when things are cheap. So, you know, for me, you know, we're looking at stuff in various companies, and we want to be active, but we're trying to be very careful and strategic so we don't get perceived as being too dilutive now. But in our hearts, we know this is the path to go forward. And for juniors, we need this really important thing called money. And money's not easy to come by. It's been a lot harder to find these days, no matter how good your situation is. And that's what we've been dealing with.
Yeah, and you both touched on one of the most, I think, one of the biggest problems or challenges, I suppose, facing the junior market, which is liquidity. I mean, you said there's too many companies, right? Now, I agree with you, and that is probably what contributes to one of the biggest challenges these companies face, which is liquidity. So, is this something that investors should be focusing on when they're approaching a new investment opportunity, when they're looking at a company? Should they be looking at the trading right now?
I think if the investor is a trader, then the answer is yes. I try to focus my investments, which means that I buy large enough positions that unfortunately I can't often avail myself of much liquidity. I have to be right. If I trade out of a mistake, I'm just going to get hurt. So I'm much less concerned personally with liquidity than I am the delta between the price that something is selling for and what I think it's worth. Now, with liquidity, and this is hard to do, the time to take it is when it appears.
Sure.
If you own a stock and it all of a sudden starts trading very, very, very big volumes, and you have a nice position, most people's temptation when a stock is going up is to ride it. If you have a big position, you have to remember when it didn't have any liquidity and how you were dying for a bid, and you take bids when you get them. When there's no liquidity in a stock, if you really, really, really like it and it's falling, you should probably give them some liquidity. You know, you should buy a little. The truth is, I think in my declining years, I've learned if I've done the work to understand a company, you do what is easiest. If there's no buyers, so it's easy to buy the stock, you buy some. And if there's no sellers, so it's easy to sell the stock, you sell some. Your heart wants to make you do the different thing. If there's no buyers, you want to hide behind the crowd. If there's no sellers, you want to ride the stock up and hide behind the crowd. My experience has been whatever the market makes it easy for you to do, you do.
Okay, now, one thing I pay a ton of attention to is investor sentiment. I like to know where money's going, right? And then I want to get there first, position myself in front of the avalanche. Ivan, you've got your fingers in 3 commodities, right? Gold company, silver company, and a copper company. Yes. Where are you getting the most attention right now?
Easiest one to get market attention is silver. Silver's leverage to gold, silver investors' performance, #1 equities in my whole career. And that's why we did silver in one of our companies, because it trades the best. Gold is always there. I'm a gold bug at heart, always was. And if it's good enough, big enough, rich enough, you'll get the attention there. You can look at Filo Mining had incredible silver hole. It's one of the best performing companies out there. Copper is the challenge. Copper is probably one of the most needed commodities on the planet with this electrification and the shortages that are looming here in the next few years. We drilled a hole, brand new discovery in Chile, land of elephants, 90 meters of 0.94 copper. It came with 0.84 gold. That's about 2.5 grams gold equivalent or 1.5% copper. The stock's down 10, 12% since we drilled that hole in elephant country. And everyone's shaking their heads, and the report from analysts, from big investors, they're all saying that. And all I'm going to say there on that point is copper's tough until it's really a problem. And I'll make an analogy, and if everyone laughs, it's just fine. But do you all remember when we didn't have a toilet paper problem until we did during COVID? I feel that's going to be what comes up one day for us in copper. One day we're going to wake up and realize how much we really need the copper, and that's going to really change things for the retail company.
And any difference in how we approach an early stage company if we're looking at a copper play as opposed to a silver or a gold play?
Much different investor audience. You have to really catch people like VRIC and show them deep value on major assets that could be substantial in size. On copper, on silver, it comes out to be how sexy is the target. It's a sexy story. It's a sexy play that's going to draw investors in, and obviously grade and scale opportunities there. But silver explodes overnight. One big silver discovery hole is going to get a lot more reaction than a good copper hole over a good whisk like we just experienced.
And Rick, over to you from the investor standpoint, when you're approaching a silver or a gold project compared to a copper project, are there different steps that you take to determine value?
There are different steps. I mean, I need to say, I personally sort of prefer copper in an economic sense. There are not many gold mines in the world that make $2 or $3 million a day.
Sure.
But there are several copper mines that make $1 million a day. And ultimately, I'm agnostic. I'm happy to make money banking. I'm happy to make money in sand and gravel. So the headline commodity doesn't mean too much to me. Monetizing investor perception the cynic would say capitalizing on mass stupidity is a different challenge. And in that sense, I think Ivan has it exactly correct. If you're going to appeal to a copper constituency, you aren't appealing to people's emotions. And doing something that doesn't involve people's emotions is sort of different for the Vancouver issuer crowd. You know, they monetize emotion. I think in the gold business, there's a very well-trodden path to coming to the point where investors understand you. And Ivan's exactly right with regards to silver. My experience has been that gold markets lead silver markets, but when the market becomes silver dominant, the silver moves much further and much faster. And the silver speculator, for all his or her wonderful traits, is a true manic depressive. I mean, a real manic depressive. If the silver price isn't moving up, they invent conspiracies. They think the world is turning upside down. And when silver is moving up, they take out a third mortgage on their house to buy some penny silver stock. Right. They're truly a mad crowd. I mean, it's fun to be in front of them. Yeah, all right.
Now, it's a more complex decision as well, right? If you're looking at a gold or a silver play, right, there's if you find the economic deposit, there's the possibility that you could raise the money yourself to build that mine. The number of suitors that might acquire you are in the hundreds. Or in the copper sector, there isn't. No junior company is going to raise the billions required to build. And the number of companies that might acquire you are maybe a dozen. Is this correct?
No. A high-quality copper deposit can be financed. If you have a high-quality copper deposit, you're looking for development finance, come see Rick Rule.
Sure.
That can get done. What you don't get in a copper deposit is speculative idiocy.
Right.
So you don't lower your cost of capital by monetizing investor stupidity around a narrative. You actually have to deliver the goods, which can be very boring if you don't have the goods. In the gold and silver space, you know, occasionally, you know, you run into a marijuana moron or a crypto moron. You run into a group of people who are attracted to the word gold or attracted to the word silver, although the issuers don't have any gold or silver. And that's very convenient if you're raising money. If you're me, I mean, trying to compete with dumb money is very, very, very dumb. So most of the time I have to be out of these speculative markets because I'm competing with people who I believe have lost their minds.
Okay. Yeah, I know you like to be the only one at the table. So if you had to pick one commodity for the year, I'll start with you, Rick, because for you it'll be like choosing between your children, Ivan. Your choices are copper, silver, gold. We're looking for price appreciation. Where do you go, Rick?
In the commodity or in the stocks?
The commodity.
Gold.
Gold. Why do you go with gold?
I think the wins are really truly in gold sales. And I don't think that I think investors are bored of the price action in gold, and they haven't paid attention to the factors that would make the gold price go up. Gold prices go up because real investors are concerned about the purchasing power of their savings in fiat instruments. Why would they be concerned? Quantitative easing. If you did it, it would be called counterfeiting, unless you were a member of parliament, in which case it would be policy. Debt and deficits. We're never going to pay off these debts, ever.
Yeah.
Especially while we're running deficits. And then negative real interest rates. Think about what a negative real interest rate is. You, a young guy, lend an old guy money to consume today, forestalling consumption yourself, and I give you my solemn promise that I'll pay you back less than 10 years. And this is supposed to be a good deal.
Right.
If there was ever anything that should cause investors to be concerned about the purchasing power of their savings, it's negative real interest rates, which guarantees a negative return. And at some point in time, arithmetic is going to take over, and investors and taxpayers and savers, pardon this in the morning, are going to say, oh shit. You know, they're going to look at their bond portfolios and they're going to disintermediate, which is a fancy word of saying sell.
Okay, Ivan, over to you.
Yeah,
gold, silver, copper.
I'm definitely not going to disagree with Rick on gold. He's got many more years on me, and a good part of being successful in this business is listening to people like Rick that have done it longer. But gold is the most emotional investment out there, and it's always led the commodity cycles. And so I'd pick gold as well for the reasons Rick just said. I'm not going to repeat those because he did it so well. But I would say for stocks, silver stocks tend to get the best treatment in a rising gold market or silver market. So gold for commodity, silver stocks, and copper, because I have to talk about my third child. If it's big enough, rich enough, it can compete with all three, as we've seen in some of the big copper things found. So that's my perspective.
I appreciate that perspective. Okay, looks like we're getting the hook. So thank you so much for coming out. Thank you, Rick and Ivan.
This is Jay Martin.